they sort of eliminate that human emotion factor that I think tends to flaw most of us when making investment decisions. We feel pressure when the markets are going down, or maybe we get too euphoric when markets are going up. AI eliminates all of that. It doesn't ever feel those issues. And I think that's the inherent advantage AI has today.
Can ChatGPT pick stocks better than the best investors? What if ChatGPT is using the best investors' thinking to pick stocks like them? My guest today, Doug Clinton, CEO of Intelligent Alpha, intelligentalpha.co, is attempting to answer that question in real time. Right now, he has one fund, the Intelligent Livermore ETF, LIVR is the ticker, but he's got a lot more in the quiver. Let's talk about how these funds work and whether or not they may be right for you. Doug, welcome.
Thank you, James. Great to be with you.
All right, so there's no shortage of ETFs today, and one might observe that they seem to be getting more and more unique, interesting, quirky, media attention grabbing in a sense. Yours, though, is particularly intriguing because it's not only using technology to pick stocks, but it's using technology, as Matt Levine from Bloomberg pointed out. Usually technology is seen as something that eliminates human error, but in this case, you're training technology on humans to execute presumably comparably good as they do. Can you give those in the audience a rough overview? A, is that right? And B, how would you pitch this first ETF in a minute or so?
Absolutely. Well, I'd say, first of all, as you mentioned, with just kind of the ETF ecosystem, the landscape, James Dyson has this great quote about being different for different sake. And I think we've tried to embrace that a little bit with what we're doing. I mean, we track several dozen different strategies at Intelligent Alpha, all powered by AI. But what we wanted to do for the first fund, Livermore, is try to use one of our most unique strategies, one that would stand out and stick out and kind of stick in investors' minds. And we've been really happy with the launch so far. So the quick pitch on what Livermore does, ticker LIVR, is it looks at about a dozen of what we would all probably agree are some of the world's greatest investors, names that would come immediately to your mind when you hear that title, greatest investor. And what the model does is exactly a Buffett, a Druckenmiller, a Tepper. I mean, guys that I think everyone kind of would agree that are really good. And what we do is we use our models to really study those investors. It's not about replication, it's not about just trying to recreate things that they're doing in their 13F, but our models study those investors. They try to understand how they think about the world. And then they take that inspiration and the models will then craft a portfolio that they think reflects how those investors would put money to work in markets given where they are today. And so that first ETF, it had exposure to China, which obviously, sitting here now, early October, has been a pretty good call with China being aggressive with interest rates. It had exposure to energy. And right now we're living through a period where energy prices are going up with some conflict in the Middle East. And so AI has been pretty good so far. It won't get everything right, but we've been really excited about the start.
And let me ask an idiot question, because I saw your prospectus. I did not read the whole thing. And you mentioned, I think it was 10 investors. Is it equally weighted? Like, how does the strategy absorb all those 10 different investors and amalgamate them into a single set of decisions?
So it'll take that inspiration from those 10 or so investors, and it will look for we categorize it as like 4 to 6 general ideas that the AI wants to reflect in the portfolio. And so an idea might be investing in the category of AI companies. That is one of the themes that's reflected in the portfolio right now.
And that's probably not a Buffett thing, I'm guessing.
Right. Yeah. I don't think that came from Warren Buffett. No. But to answer your question though, right, it is kind of an amalgamation of all of these different investors, different styles. So you won't necessarily see it be a pure, value play, just like Buffett, right? Or it won't necessarily be a pure tech play if we were looking at someone like a Philippe Lafont from Coatue or something like that. So it is a mix. You get different feel, and I think that's kind of a fun way to put the portfolio together.
Is there a risk, just being devil's advocate, of too many chefs in the kitchen? In other words, I don't know how many positions this ETF holds or if there's a target turnover or not, but Warren Buffett's favorite holding period is forever, and there are other top investors, James Simon. I'm guessing he's not, a secretive quant guy is probably hard to model in your system, but some investors may have quicker turnover. How do you balance that?
So the portfolio tends to hold 60 to 90 different stocks.
Mm-hmm.
Generally, the portfolio is reviewed every quarter or so, sometimes a little bit more frequently. And I would expect the turnover to be, probably something over 100%. So it will likely turn the portfolio over entirely in a given year. But I think what we kind of think about when we put together this model and these inspirations from various investors is not that they have to own these stocks forever, because some stocks probably will be in the portfolio over very long periods of time. But really what we're looking for is stocks that the models think can outperform in kind of a 6 to 24 month period. That's generally
Mm-hmm.
the time frame that we instruct the models to think through. And so obviously if you have a great winner like an Apple over the past decade, hopefully the models are able to keep that one in the portfolio. Whereas let's just say energy, I have no idea whether that will stay in the portfolio or come out. Maybe AI views that as a little bit more of a trade.
How soon do we need to wait until we know if it's working? A year, if that's roughly your turnover, or do you have a different date in mind?
Well, we've done a lot of research before we even launched Intelligent Alpha and our first ETF. So we started experimenting in about July of last year. And we track about 3 dozen different strategies with over a year's worth of real data, not just back testing, but real data. So in our opinion, we have enough data that gave us confidence to launch the first product, certainly, but also to say that we do think that this mechanism of using large language AI models to pick stocks will work. I think what we kind of think about as the future is two-parted. Today, like, what is the advantage of using large language models as an investor? And I think the biggest advantage is they sort of eliminate that human emotion factor that I think tends to flaw most of us when making investment decisions. We feel pressure when the markets are going down, or maybe we get too euphoric when markets are going up. AI eliminates all of that. It doesn't ever feel those issues. And I think that's the inherent advantage AI has today. Over the longer term, the second piece of our thesis is that AI will continue to get better and better and better from here. I mean, we're using the iPhone 3 right now, right? And we're going to get from iPhone 3G to iPhone 15, where we are today. And I think we'll feel that real difference in terms of the intelligence of the models, the capability of the models, and that will also reflect in, I think, better investment results.
How much do you know about how the model does its stuff? And one question, which you may or may not know, is there a factor tilting? And I'm using that word because that's what I know, but in this case, it might be an investor tilting, meaning if we happen to be in a raging tech bull market for a while, and the model senses that, and the model senses that maybe Warren Buffett's style is not so great in that market, but somebody else's might be. Would it react to that? Does the market kind of like see who's hot, or does it do something different? How much do you know about how the model works in general?
So I'll hit the factor piece first and then how the model works second. In terms of factors, there's two ways you can kind of address that. One is we do, in some cases, specify certain factors that we think the model should consider. And so, for example, I mean, if we're doing most basically, right, a momentum-based strategy, then obviously we'll want the AI to consider momentum as a really important factor when it makes its investment decisions. But
And
even
so,
more
just to be
nuanced.
clear, you guys would sort of step in and manually override and say, we besides these 10 investors, we personally like momentum right now. Am I understanding it correctly?
I would think of it a little bit less like a manual override and more like a specific injection in terms of the philosophy that we're giving the AI. So if you just say, okay, base philosophy, right? Act like a great investor. Here's a set of great investors, and you can kind of understand what they do. If we're trying to emphasize a specific factor, we might say something like, okay, here is a set of great investors, and that means they kind of invest like this. But we also want you to specifically consider in your overall investment process the momentum factor, right? So look at what price momentum has been for 30, 60, 90 days, whatever period we want. but that would be something that we would sort of specifically inject into the instruction set of the model in that case.
So if we are looking back from 10 years, the trailing 10 years of returns, what's your best guess in terms of R squared or whatever you want to think about it, the performance attribution for those 10 investors, so to speak, versus your own, the Intelligent Alphas team, either supervision and nixing weird looking stuff, or kind of a leaning or nudge like we like momentum right now. If you broke those into two sets, what do you think the performance of each is relatively speaking?
So we've done a bit of an experiment on this, and I probably can't share specific performance numbers, but the idea, and this is a great question that we tend to get from investors, right? Of does the AI add alpha if left alone and kind of to its own devices versus, if there is maybe some human override or some human who is in the loop and maybe specifying certain things that the AI should do, does that add alpha? And the short answer is from our test, the AI only strategy performed better than the human plus AI strategy. Now, certainly for other strategies, maybe that would look different. But I think the overall kind of answer to the interest behind the question, right, is like, is AI capable alone in and of itself? I think the answer is yes. And I think we've seen, at least in some of our testing, that it can, in some cases at least, outperform the human with AI.
Okay, so then I guess the follow up, why bother doing any human interference? But if it's something that tends to bring the returns down, why wouldn't you just let AI go crazy? Just fear of some extreme outcome, long tail event or something else?
That's part of it. So within our process, we have kind of like a human final redundancy layer. So once the AI creates a portfolio, a human will verify it and say, okay, yes, this reflects the intent of the strategy. And so, as an example, right, if we were doing a U.S. small cap stock portfolio and it for some reason picked a bunch of European large cap equities, we'd say, hey, something's wrong with this portfolio. We need to go back to the drawing board. So we do have that redundancy just to make sure that there's not an issue with errors.
And that seems like a very basic kind of common sense check. Nothing
right.
Perspective, so to speak. Yeah.
That's exactly right. And then if we kind of expand that and go back to our example about momentum, sort of injecting the idea of momentum into the AI, I actually don't view that specifically as sort of a human intervention. I view that as a specification on the strategy we want the AI to do. And so if you think about just the ETF landscape, you look at like a BlackRock, for example, I think they have 270 or so different equity ETFs, and they each have different, target exposures. They have a momentum focused ETF. And the way that we look at the world is we want to be the largest AI powered asset manager in the world. We want to be $1 trillion asset manager. To do that, I don't think you can just have one single fund. You need to have a family of funds, just like BlackRock. And just like BlackRock, we need to have a product that does specifically target momentum. We need to have a product that maybe just specifically targets low beta or something like that. And by injecting that specific idea into the models as we use them, that allows us to create all these various strategies.
Got it. So reading between the lines, right now you've kind of got a kitchen sink ETF. You're starting with kind of an all-in product, but you're hoping to diversify to more and more niche things that might be a little bit more, would be more singularly focused on a certain investor or a certain strategy. Is that right?
That's exactly right. Yeah, we wanted to try to do the most unique thing we could do out of the gate. This sort of like, I almost think of it as a mini multi-manager strategy inspired by the world's greatest investors. And then from here, we will have other strategies that are maybe a little bit more similar to trying to invest in, a large cap US equity strategy that beats the S&P 500, something like that.
And so LIVR is the current one you got now. What's the expense ratio on that? And what's an appropriate benchmark? S&P 500?
The expense ratio is 69 basis points.
Okay.
Livermore is, it's a global equity portfolio. Minimum market cap is 1 billion. So we think the right kind of comp is something like the ACWI, the MSCI All World. But I'm sure a lot of people are obviously just going to use the S&P 500 as well. We pay attention to that too.
S&P 500 is it's not a small cap index per se, but it has a lot more mid caps and even a few small caps, I think, compared to what most people think. So you're a little bit bigger in terms of market cap than a lot of the S&P stocks. Or some of the smaller ones, I guess. That's interesting. So, Doug, this is certainly very interesting, and it sounds like the opening of a new door. One philosophical question I just want to ask. So traditionally, the logic has been, and as you mentioned to me today, that there's human thinking, which is fallible. We have tons of cognitive biases. We all know those things. And in fact, those are good because though for other investors, because that's how they make money, right? We make money by exploiting other people's cognitive biases. And then this idea of machine investing years ago came along. The machine is unemotional. It's perfect in terms of its execution. It doesn't have those human flaws. When you have a machine sort of copying a human, it's kind of a weird circular logic that may be beneficial. My question is this: do you see it as a tracking error situation, like the Warren Buffett ETF, when one day you have a pure play Warren Buffett ETF? Will it be like how close to Warren it can get? Or is there any chance that it could actually out-Buffett Buffett?
I mean, the goal, James, is certainly to try to out Buffett Buffett. Many have tried before, many have failed, and we'll see if AI is capable up to the task. But that's how we think about the world for all of our strategies. Is that if we're right that one of AI's superpowers is eliminating that human cognitive bias that you mentioned, and another AI superpower that I think is continually evolving is the actual base level of intelligence and capability of the models, then it stands to reason to us, at least over time, that these models should be able to think better, I think, than the market, which is still going to be represented kind of by the aggregate of human investment activity, at least for a long time. And so that's our thesis is, look, if we can kind of create a little bit of edge by eliminating emotion, which is certainly, I think, in many ways what Buffett has created his edge on, and many other great investors as well, but then also add some of that intelligence to maybe think about ideas, think about the world in a little bit of a different way. Hopefully that does result in better performance over time.
As an entrepreneur, I have to ask, separate from investing questions, if this thing takes off, if this thing shows good performance, do you worry that JP Morgan or Merrill Lynch, Fidelity, whoever is going to say, that looks interesting. Let's deploy hundreds of millions of dollars and an army of PhDs to do what Doug is doing, but better? Is that a risk to you?
It is a risk. And I think that, when we think about being a startup, my other firm, Deepwater, we started as a venture capital firm. We still make venture capital investments. I still make venture capital investments as a partner there. So we've seen, I think, a lot of the threat, right, that's always inherent to young startup businesses that are trying to innovate from bigger established giants. And the way we think about it is, we were the first really to bring a large language AI model powered ETF to market. And when you're first, when you're in the lead, you just have to keep moving as fast as possible and you can stay in the lead. I think that's the advantage, as it were, for every startup is that you're small, you're nimble, you can try to do things faster. You don't have all of the overhead infrastructure and politics at something like a big asset manager, BlackRock or someone like that. And so we need to just do as much as we can to take advantage of that leanness. And that's our plan over the next, 6 to 12 months. We have a lot more products we want to bring to market and hopefully really put a stake in the ground and say AI powered investing is ready for prime time.
Yeah, and hopefully, at least in a worst case scenario, those big guys would buy you rather than try to compete with you. That would be better for Doug, I'm guessing also. So Doug, very interesting. This is, it's not just a new ETF, it's a new whole category. It's a whole new way of thinking based on a technology that is starting to change the world. So I applaud you for being at the vanguard of this effort. If someone is as intrigued as I am in this, where would you send them to learn more?
Two places. You can follow me on Twitter. I'm at Doug Clinton, and I often tweet about just things we're learning. It's fun kind of being on the frontier of doing something new because you experience a lot of things firsthand that no one else has tried yet. So, for example, just today we wrote about a test between GPT-01, OpenAI's most recent model, and GPT-4o. So you can find that on Twitter. And then you can also visit our website, intelligentalpha.co, where we also have a newsletter and we detail a lot of what our AI investment committee is saying about stocks, markets, and everything else, if you want to follow that.
Sounds great, Doug. All kinds of new ETFs popping up as we talked about, but yours I feel has a bit more teeth than most. So I certainly wish you all the best of success. I will be keeping my fingers crossed, and maybe I'll put a little investment in one of your funds too. So thank you very much for taking the time to talk with me today, and thanks to you guys, as always, for watching us at home.